Good morning friends. Welcome to the digital platform of Institute of Banking Studies. Today we have selected a topic which is a topic in your credit management. Today we will try to read a balance sheet. We will try how to read a balance sheet. Okay? What is a balance sheet? Balance sheet is a snapshot of total assets and liabilities. That means statement of affairs of the business. Affairs includes assets and liabilities. Of course, these affairs are the uses and sources of fund. It facilitates the unit to assess the various ratios, solvency, etc. In a nutshell, we can say that assets are what company owns and liabilities are what company owes. With this, we will start our discussion. Balance sheet, if you look into the balance sheet in a vertical form, you can visibly understand what are the items listed on the asset side and what are all the items listed on the liability side. Under asset side, the major two categories are there. One is current assets, the remaining are non-current asset. But non-current asset, for our easy understanding, we have divided it into three different categories: fixed assets, non-current assets and fictitious asset. That means intangible assets. Similarly, on the liability side of the balance sheet, if you look into, there are two major categories. One is current liability, another one is other than current liability, that is non-current liability. Non-current liability again we have split into two, that is one is term liabilities, another one is net worth. Actually, term liabilities and net worth are long term only, but in order to specify that what is the amount due to the proprietor himself, it is categorized under net worth. Okay friends, now you can see, visualize the exact position of a balance sheet. It is the picture, exact picture. Why I said like that? Because it shows the sources and it shows the uses of the funds. On the left hand side, on the liability side of the balance sheet, sources are there, short-term sources are there, long-term sources are there. On the right hand side, short-term uses are there, long-term uses are there. So here, current liabilities are short-term sources, current assets are short-term uses. Similarly, term liabilities and net worth are long-term sources, fixed assets, non-current asset and intangible assets are long-term uses. So the funds are coming from this area and the funds are deployed in these areas. At any given point of time, the total assets will equal to total liabilities. What is a current asset? If we examine the nature of a current asset, those assets which can be converted into cash within a normal operating cycle, or we can say within a period of 12 months, that can be considered as a current asset. How fast the asset can be converted into cash? Here I have listed some of the features of the current asset: expected to be realized or consumed or intended for sale within normal operating cycle, maximum 12 months, can be realized within 12 months and held primarily for the purpose of trading, cash or cash equivalent, that is example we can take bank balance, term deposit receipts, etc. Irrespective of the tenor provided, there is no lien. If there is no lien or charge against it, suppose there is a lien, we cannot consider it under current asset. Prepaid expenses and advance paid to suppliers also current assets, and the examples we can cite: stock, debtors, prepaid expenses, advance paid to suppliers, bank deposits, investment in shares, treasury bills, cash in hand, or any item that is due within a period of maximum 12 months. They are short-term funds used in a day-to-day operations of the business. Similarly, if you examine the non-current asset part, the non-current asset part, it is visible that it can be exchanged into cash after a long period of time. That is, it may take sometimes more than 12 months and more than 36 months or even more than 7 years or 10 years like that. So non-current assets are those assets which can be converted into cash in long term. Examples are fixed assets like land, building, plant, machinery, equipment, furniture, vehicles, fixtures, which are known as gross block. They are long-term tangible assets available in the business for years and used for conducting business operations. They are not intended for sale. When expressed in purchase value, it is gross block, and when it is expressed net of depreciation, then it is net block. So friends, remember this, whenever the word block is being used in the balance sheet, it denotes fixed assets. If it is gross, it is at the purchase value. If it is net block, then it is after depreciation. Then comes other non-current assets like investments maturing after 12 months, security deposits more than 12 months, etc. You can take one example. Suppose you are applying for a telephone connection. Normally the telephone department will ask you to deposit certain amount by way of security deposit. This deposit you will encash it after a period of time when you choose to disconnect the telephone connection, is it not? When you want to surrender it, then only you will get that money back. So that is a very best example for your non-current asset. Similarly, suppose a fixed deposit is in the bank and you have made marked a lien for the fixed deposit for getting a letter of credit facility. So that fixed deposit you cannot encash it shortly. So that is also a part of current asset. Then comes fictitious asset, intangible assets. They are fictitious or intangible in nature and have no physical presence. Very best example is goodwill or patent rights. Even you can go for patent rights, trademarks, copyrights, preliminary and pre-operative expenses, discount on issue of debentures and shares, underwriting commission, miscellaneous expenditure, profit and loss account, debit balance. All those things are included in the fictitious asset. Now I will give you some one simple example how you can understand the term goodwill. Just you see, watch this table. Here ABC company is taking over. ABC company is selling their business to XYZ company. So XYZ company is purchasing the business of ABC company. At the time of purchase of this business, XYZ company has perused the balance sheet of ABC. Balance sheet shows this is the position: current liability 25, term liability 20, net worth 30, total 75. Current asset 40, fixed asset 25, non-current asset 10, total 75. So definitely what XYZ company will do, XYZ company will take over the entire current assets, it will take over the entire fixed assets, it will take over the entire non-current asset, and simultaneously it will take the liability of the firm also 25, term liability 20. So definitely this amount is the amount which ultimately XYZ company has to pay to ABC company. But at the time of payment, XYZ company, they are compelled to give 2 rupees extra to ABC. Why? Because ABC has claimed that they have created a reputation in the market, and for that reputation they want 2 rupees extra. That means at the time of purchase, in addition to rupees 30 by way of the net worth of that particular ABC company, XYZ company is compelled to pay 2 rupees extra. So how they can account it? If they are giving 2, they have to give it from their capital. That means the capital will come to, net worth will come to 32. In order to match this, there is an intangible asset created on the asset side of the balance sheet, that is goodwill. That is how a goodwill is being introduced in business. We will just, I will wipe this out. So now I think you can understand this thing. Whenever if you talk about this goodwill on a future date, this is how the goodwill is being created in business. Then comes current liability. Of course, just like current assets, these liabilities are those liabilities which are to be liquidated within a short period of time, normally within one operating cycle or 12 months, whichever is earlier. It includes cash credit accounts from banks, overdrafts from banks, short-term loans taken from friends and relatives, bills payable, sundry creditors, short-term provisions, advance received from customers, expenses due for payment, etc. Installments due and payable within next 12 months in respect of a term liability is also treated as a current liability. That is, whenever the business firm is availing a term liability from a bank, normally the term liability should be liquidated in fixed installments. The installments may for 60 months or 84 months, like that. So here one prominent point which you have to remember is whatever the nature of the term liability, whether it is 60 months or 84 months or 120 months, the next 12 installments due for payment is actually a current liability. The remaining part only can be treated as a term liability. Remember this when you read a balance sheet. Then comes term liability. Of course, those liabilities which has to be liquidated after a period of 12 months. You can take long time, the business will take long time to repay it. Those type of liabilities are term liabilities. Examples are term loans from banks, NBFCs, debentures and bonds, any other debt which is to be liquidated beyond 12 months like deferred liabilities and loans from friends and relatives. Even long-term provisions we can include in term liability. The last one is net worth, of course. The last priority will be given for net worth. Why? Because the net worth is the amount applicable or due to the owner himself. When the business will give this money back, whenever the business is going to be liquidated, then only it is essential for the business to pay this amount to the owner. So that is why it is the last one, and this is known as net worth. This net worth is completely the amount owed to the owner of the business. Net worth is the contribution from promoters, includes equity, preference capital. It includes all types of reserves and surplus. Surplus means profit and loss account credit balance, and it includes premium on issue of shares. It is a long-term source of fund. This is the amount payable to the promoter at the time of winding up of business. Hence, it is a liability. Hence, it is the liability towards the owner. Just you watch this. This is the sum up of the balance sheet which you have read so far. See, current assets and fixed assets, non-current asset, intangible assets. And here current liabilities, term liabilities, net worth. So I have marked certain arrow marks here because there are some relationship between these items. There is a direct relationship between current liability and the current asset, because the current assets are acquired out of current liabilities. Whatever is the deficiency, that should be bring in by the proprietor in the form of capital. Term liabilities are directly connected to fixed assets, and mostly the non-current assets and intangibles are funded by the owner himself. That is why these two arrow marks has been given here, and certain questions I have framed here. Just you can watch this one by one, we can analyze this. First one is creditors for goods supplied. Creditors for goods supplied, it is sundry creditors which has to be repaid within a period of 12 months. Hence, it is a current liability. Investment in government securities like treasury bills. Normally, treasury bills, you may be knowing that it is 91 days, 182 days and 364 days, like that treasury bills are being quoted in the market. So anyway, it is within 12 months. That is, it is a investment with which we can encash it within a period of 12 months. So it is a current asset. Fixed deposit with banks. Even though the fixed deposit is for a longer period of time, but at any point of time we can withdraw the money by giving a premature closure letter. So in that sense, fixed deposit with the banks can also be considered under current assets. Cash credit and overdraft. This is a facility, credit facility, which is being sanctioned by the bank for a maximum period of 12 months. Thereafter, it has to be renewed. So since it is for a maximum period of 12 months and to meet the working capital requirement, it is current liability. Security deposit with a telephone connection with the telephone department. That is a non-current asset because it is for a longer period of time. You have to keep this deposit with the telephone authorities. Debentures issued. Debentures issued means the company has borrowed funds from outside on certain terms. Normally, debentures are issued for a period of 5 to 7 years or 6 years, like that. So it is definitely a term liability. Statutory liabilities with the PF and gratuity. So those statutory liabilities are normally, it has to be repaid as early as possible. So it has to be remitted. It has to be remitted as early as possible. In that sense, it is a current liability. Loan taken from NBFC for delivery ban. Normally, delivery ban, those type of fixed assets are acquired by availing term loans. Term loans means it has to be repaid in installments. It has been availed, the firm has availed this from an NBFC. So in that sense, it is a term liability. Finished goods, it represents stock of items, current asset. So it is coming under current asset, stock of items. Installment of term loan due within 1 year. Just I pointed out earlier, whatever installments due within 1 year in case of a term loan, those installments can be considered as a current liability. Prepaid expenses, it's a current asset. Advance payment of tax, current asset. Salary payable to staff, it is an expenditure which is outstanding. So it is a liability when it has to be paid as early as possible because it is salary to the employee. So in that sense it is current liability. Okay friends, that's all today.
If you like our content, do like, share and subscribe.